Good morning and welcome to this Wednesday, May 25th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got futures down again just a bit this morning. NASDAQ futures getting hit just a little bit harder on a relative basis. Dow futures down a little more than 100 points, S&P 500 futures down about 15, NASDAQ futures down around 50. But on a percentage basis, we are seeing just a slightly bigger drop on NASDAQ futures. Crude oil right now up $1.44 per barrel to $111. 10-year Treasury yield down another couple basis points, 2.74%. And by the way, that 10-year Treasury yield, we'll look at that chart in a minute, but that has been playing out, that negative divergence that we talked about when it was up over 3%. Talked about maybe we could fall back to the 50-day, which at that point I think was maybe around 255 or something. But talked about the fact it would be coming up and that there was yield support around 265 to 275. Well, there we are. So that negative divergence on the yield certainly has played out. We've seen the yields dropping. Hasn't done much to help the market. Which again is pretty interesting because when yields were going up, that was the reason why the stock market was dropping, according to media. Don't know why. When the yield comes back down, that should lead to a big rally, but it hasn't. Market continues to build in a lot of negative news. It's been building it in, and we're seeing the negative news coming out now. I don't know if you saw Dick's Sporting Goods this morning. They came out with their earnings. And by the way, their earnings blew away forecasts. So when we talk about the stock market forecasting and actually, when you look at the charts, you're looking at fundamental news 3 to 6 months in advance. This is what we're talking about. I mean, Dick's Sporting Goods has been down. Retailers have been getting killed. They're coming out with good news. I mean, let me give you, and we'll probably talk about this a little bit later in the show as well. Let me give you the numbers on Dick's Sporting Goods. So they were expected to earn $2.43 this quarter. They earned $2.85, 42 cents above expectations. Stock, last time I looked, was down 12% this morning. They cut their outlook. So there's your fundamental news hitting this morning. And the market, Dick's Sporting Goods has been going down for quite a while. I mean, this is nothing new today, going down, 12% or whatever. Dick's Sporting Goods back in November was $140. Yesterday it closed at $71. So basically a 50% off sale. And now we're going down another $11 today, which is another 15%. I mean, it's been brutal in the retail space, but you've got to pay attention to the charts. Charts are telling us all this. Consumer stocks, discretionary stocks, have been going down relative to staples since November. This is nothing new. Some of the news might be new, but the charts have been telling us this for a while. Anyhow, let's go ahead and jump in here. Excuse me. So we'll start here at EarningsBeats.com. For those of you that are new, I always like to start with our homepage. Just to let you know, we have a free newsletter. So there it is. You can scroll down, name and email address is all it takes. You can subscribe there, hit that button. 3 times a week, we have a chart come out. Actually, this morning I featured IBM. IBM had a really good earnings report recently, gapped up, struggled to get through some key overhead resistance around 140, 145 area. And when I say struggle, I mean for like a decade, it's been struggling to try and get through 140, 145. But anyway, it came back down just a couple of days ago, hit gap support around 129, and then is starting to rebound again. Watch that 140, 145 area. But that was the Earnings Beats Digest article for today. But we've always got something, I think, of interest that looks interesting technically. We focus a lot on earnings and relative strength and candlesticks and those sorts of things. I think you'll find it interesting. And also being a part of this group, our EB Digest gets you into all of our free events when we have those from time to time. We always send out room instructions to our entire Earnings Beats Digest community. So another reason to be a part of that Earnings Beats Digest newsletter. Also, just want to mention quickly that we have our spring special running through Monday of next week. So only 5 more days left. This is our biggest deal of the year. You will not get a better offer from us throughout the year than what we offer during our spring special. You buy 1 year, you get 2 months free. Buy 2 years, get 6 months free. And if you buy 3 years, you put that kind of commitment into us, we'll give you a year free. So that's 4 years for the price of 3. And like I said, valid through Monday, May 30th. So make sure you check that out. Looking at the action from Tuesday, we had the Dow Jones Industrial Average up 48, S&P down 32, NASDAQ down 271. That relative weakness in the NASDAQ continues. That is not how bottoms normally are carved out. We need to see some money rotating back into those offensive areas of the market, technology, consumer discretionary, and so forth. Mid caps down 29, small caps down 13. So everything went down except the Dow. We did get just a little bit of movement upside in the Dow yesterday, finished almost to 32,000, pretty close. We traded over 32,000 intraday, couldn't close there. But it was bifurcated action. We did have one index up. Utilities led the charge to the upside, up 2%. Staples, 1.64%. Does this sound familiar? Defensive groups leading. How about bottom of the sector leaderboard? Communication services down 3.5%. Discretionary stocks down 2.5%. Technology down 1.5%. Those are your 3 aggressive, the 3 most aggressive, the 3 I watched the closest right there. And the market shows selling, and these 3 lead the selling to the downside. Just not good action. And honestly, I'm just not seeing a whole lot. Communication services, we did have a false breakdown yesterday, and you can see that PPO starting to rise. It would seem like we'll bounce on communication services. And this is home of internet stocks. I mean, that's one group that I tend to follow very closely. That tends to be a very aggressive group that leads the market during secular bull market advances, but also tends to perform poorly during cyclical bear markets. And that's what we're in right now. And that group has been very, very weak. However, we do have a positive divergence on the XLC. We didn't get a lower close. So technically, PPOs, MACDs, they're based on closing prices. So technically, you need to get a lower close with a higher PPO for a positive divergence. And we didn't get the lower close. We did get lower intraday. Still, I think clearly momentum seems to be improving while price action keeps going down. So maybe a slight positive there for the XLC. We'll see whether that materializes. We are getting close to the end of May, early June. Historically, this is a pretty good time of the year. Normally, we see the market move higher in anticipation of new May money or new June money flows. And so we'll see what happens there, but at least we do have a positive divergence in communication services heading into that. Discretionary, that PPO just keeps going lower and lower with price action. So momentum is actually accelerating to the downside. So not seeing that same positive divergence there. Technology on the most recent lows, we do have lower PPOs. It seems like it's trying to stabilize the PPO a little bit, but I would say at this point, bear is still in control here with technology. So, you know, when you look at the action, it's just hard to get bullish. I know how much we've fallen. We should bounce, you would think, at some point. But, you know, yesterday we bounced, today we got red futures. It's just, it's hard to really trust anything. And then, you know, with the sentiment readings, what they've been, I mean, we still are not at that ultimate 5-day moving average of the equity only put call ratio. I think I pointed out back in, well, in this century, I think I pointed out 18 significant market bottoms this century. 15 of the 18 came with the 5-day equity only put call ratio hitting 0.80. 15 out of 18. The other 3, we saw it get to 0.75. Well, we did get to 0.75 currently, but we have not hit 0.80. So most of the significant market bottoms have come with more fear in the market than what we're seeing right now. The VIX, I mean, the volatility index has been sitting around, you know, 25 to 35 a lot of this year. I mean, the fear just won't go away. And yet we haven't seen in what I think is that, you know, that capitulatory move to the downside where, I mean, things just get crazy. You might think, well, yeah, things have been crazy. Well, if you look at certain stocks, Snap yesterday down, I don't know, 45% or whatever it was. I didn't even see what the final, I know it had a very, very rough day. 43% it was down yesterday. Stock was $83 in September. Yesterday closed at $12.79. Okay, so that one's crazy. There are some crazy ones out there. Netflix, 700 down to, wherever it finished yesterday, 200 or actually under 200, 180. Finished down at 180 yesterday, down $7. So there's another one. So there's definitely crazy in the market, but I'm talking about the day where Apple goes down 10 or 12. I mean, everyone just says, you know what? I don't want any more stocks. I don't want any stocks ever again. Honestly, that's what this market needs to put in a bottom. That and some rotation into some key areas of the market, like the technology, consumer discretionary. We're not seeing any of that. I'll show you a chart here in just 1 second on that. Anyway, let's keep moving on here. 10-year Treasury yield. The update here, 2.74%. There's that 50-day test I was talking about. When this negative divergence first printed up here at 3, I think we hit a high of 316 on the yield, 10-year Treasury yield. Higher prices, lower PPO. We were at 316. The 50-day moving average at that point was 250 and rising. Well, here was the two most recent lows. I'm going to say right around 265 to 275. So I was thinking maybe we'd pull back into that range, test this rising 50-day moving average. Well, that's exactly what we've done. So we have moved back down, and we have seen strength in financials, which is kind of strange because normally rising rates favor financials. But during this whole period, as you can see, at least since February, this move up from February has been accompanied by relative weakness in financials. This is the relative strength chart of the XLF relative to the S&P 500. It's been going down. Now, when yields start dropping, we're actually seeing financials outperform. So it's been kind of a crazy relationship there. But bottom line, if the 10-year Treasury yield is rising because of inflation and, well, you got fear. So you got a lot of folks that are just bailing out of everything. You're getting out of stocks, you're getting out of bonds. But mostly when the 10-year Treasury yield's going up because of inflationary concerns, that's not necessarily a good thing for financials. If it's going up because the economy is strengthening and folks are getting out of bonds to get into the stock market, that's a good thing. But that's not what's happening. As folks have been bailing out of bonds, they're not getting into stocks. I mean, here's the move. This shows us they're getting out of bonds. The yield moves inversely to the price of bonds. Always. It's always 100% inverse. So if the yield's going up, that tells you Treasury prices are going down. So yields have been going up this year. Treasury prices are going down, meaning folks are selling bonds, which creates a ton of proceeds. And then that money, if we're in a decent economy, should go into the stock market. Well, here's the stock market. I don't think I see any money going into the stock market, not net. Since beginning of the year, we were at 4,800. Now we're at 3,800, which, by the way, is a bear market, which I talked about back on January 8th, Market Vision 2020. We were sitting up here on January 8th. We had pulled back just a little bit from that high. But I gave 3 target levels. I said my minimum downside target was 4,300. Next downside target was that bear market, 3,800, 20%. And I thought the extreme, if things really got bad, 3,500. I still think there's a chance we get the 3,500. But that was a pretty good forecast from 5 months ago, 5.5 months ago. So what's wrong with this market? Why aren't we coming back? Well, I'll let everybody talk about the fundamentals because I like to follow the charts. The charts tell me what I need to know. I mean, my background is in public accounting. I took economics courses when I was in college. I mean, I feel pretty comfortable talking about economics and how everything works. But the fundamentals, if you study the history of the stock market, fundamentals turn way after the charts. If you're waiting to get good news, good fundamental news, the stock market's going to be up 30% before you start hearing it, because the market prices in the good news. But just like the price, prices in the bad news. We've been coming down for months, and we're, starting to see more and more bad news as we move lower. So follow the charts. Charts are going to tell you a lot more. So let's look at the charts. Here's the S&P 500. And I want to just show you what I consider my sustainability ratios. These are ratios that I follow that either help to support the direction of the market or start to make me think that we're maybe going to get a reversal in the market because my ratios are starting to head in a different direction. So I think it's pretty clear that this year we've seen the S&P 500 dropping. I think everybody can agree on that. Had a couple of periods where we had, nice rallies, but for the most part, it's just been down. It's been ugly. It's getting painful. And, there seems to be no end in sight. Well, if you look at the Russell 1000 growth versus Russell 1000 value, so growth versus value, this is large cap level. Take a look at what happened at the very top here. S&P 500 went up. This ratio started going down. So it was going up with the market until December, and then it went down. And it keeps going down, and it's setting new lows. Yesterday set a new low. The S&P didn't, but this ratio set a new low. Not really showing any signs of this reversing at this point. Then we go down to, this is the Dow Jones US Large Cap Growth Index versus Dow Jones US Large Cap Value Index. Same thing. Topped back in November. Set a new low yesterday. Mid cap growth versus mid cap value. This topped, I think it was back in September. Down here setting new lows. Small cap growth versus small cap value. Once again, trending lower and lower. Haven't, we set a low a couple weeks ago. We haven't taken that out yet, but clearly trend is lower. Consumer discretionary versus consumer staples. I mean, a couple of days ago we saw, or I guess that was yesterday morning, where we saw the market moving up. And while the market was moving up, consumer staples were setting new lows, or excuse me, consumer discretionary setting new lows versus consumer staples. We set another new low yesterday. The QQQ versus the S&P 500. QQQ's got, doesn't have many financials in it. Very, very heavily weighted in technology and consumer discretionary names and communication services. I mean, it's much, much, much more growth oriented. The S&P 500's got plenty of growth stocks in there, but also it's rounded out with a lot of value companies. So when you look at this relationship between the QQQ and the SPY, which is these are the two ETFs that track the NASDAQ 100 and the S&P 500. If you look at the ratio, again, in December, it started going down while the S&P was trying to go higher. The S&P was going up, but it was no longer being supported by the growth stocks on a relative basis. Some of them went up in the month of December. They just weren't going up as much as the value. Money was rotating. Wall Street was under the surface, moving into defensive areas. And now you can see the result of that. Look at the QQQ moving to a new low again yesterday. It's not stopping yet. The rotation that we saw all the way back in December has not stopped. Continues falling. So what do we do with this? I mean, you can be a hero and jump in the market. And actually, I think getting into the market in pieces makes a lot of sense if you're just trying to slowly build, because you don't know, the market might bottom without seeing some kind of a bottom in these ratios first. I'm not guaranteeing that we're going to see this turn up before the S&P 500 hits its final low. I don't know how this bottom is going to form. We're already down at the low. The S&P was down 20% from its January high. The NASDAQ, I didn't calculate it, but it's probably down 30%. Those are big numbers. So if you got out at the beginning of the year because of the potential of a big decline and you're looking to get back in, I would absolutely be starting to get back in if you just wanted to buy into like the ETFs, slowly work your way in. I like the QQQ. I like the Spider. I like the XLK, the XLC, the XLY. I believe we're still in a secular bull market. And those are the three sectors that lead secular bull markets. But we've got to get through this cyclical bear market first. And I believe it's going to bottom in June, but maybe we go out to September, or maybe we bottom in June, rally, and then we come back down in September and double, put in a double bottom. I'm not sure how it's going to form, but I still think we are going to get a bottom. And I think we're going to go back up. And I think there are going to be a lot of people surprised. People were surprised at how fast we went down. I talked about that back in December. People are going to be equally surprised how fast we go back up. It's my story, and I'm sticking to it. Or at least for now, I'm sticking to it. XRT, I wanted to talk a little bit about retail because retail topped in November. There's the XRT. The XRT, we're not talking about 2 or 3 stocks that are carrying the XRT or causing it to go down. When you look at the XLY, which is consumer discretionary, Amazon and Tesla are probably 40% of the XLY. When you look at the XLK, you're looking at, stocks like Apple, Microsoft. You look at the XLC, you got Google, Facebook. When you look at the XRT, this is spread out literally over hundreds and hundreds of companies. This is a very, very well-diversified retail ETF. No 1 or 2 or 3 companies controls anything here. This is the entire sector that has just been obliterated since November. 103 at the high, upper 50s on the close yesterday, 59 and change. And then we get more bad news out with Dick's Sporting Goods. This is not good at all. So, and if you look at a longer term, we got 5 years with the weekly chart. I mean, I'm seeing nothing yet that tells me retail's hit a bottom. I think this high right here, which came in at about 50, and then you get all this congestion here between 48 and 53 or 54. It just seems to me like it's going to gravitate into that area, either the low 50s, maybe even into the upper 40s before possibly we find a bottom. I don't expect we're going to go down to the pandemic lows. That would be pretty surprising, but I wouldn't be surprised in this area right in here. To go back down and test that area wouldn't be shocking to me. And it's only, from here, even 49 is 20%. Probably going to get a pretty good haircut today at the open. So we'll see. Anyway, we'll talk about Dick's Sporting Goods in just a minute. I've got a big event coming up tomorrow night, and it's on historical trends. And if you don't believe in historical trends, let me just point out a couple things quickly here. These are just a couple things I'll talk about tomorrow night, plus much, much more. But this is a chart of the S&P 500, basically since 1950. So it's 72 years. And what I did here on this chart is I just listed, obviously, the 5 trading days of the week, Monday through Friday. And then these are the annualized returns for each of these 5 trading days. See anything odd on this? Maybe like this minus 13.87%. Do you know what day that is? Which day of the week produces annualized returns of minus 14% since 1950? Any ideas? I'm going to be talking about it tomorrow night. I find when I started analyzing the market, I found some of the most amazing statistics that I've ever seen. And I love statistics. I love analyzing. I love calculating, trying to figure out what's going on. And, if I can gain any advantage whatsoever. I don't know if any of you all are baseball fans. I was a huge baseball fan growing up. And my favorite team to then and still is, I'm embarrassed to say it now, Baltimore Orioles. I grew up in that area. Anyway, I was a huge Baltimore Oriole fan back in the 1960s, late 60s, 70s. Had the great pitching, Jim Palmer, Mike Cuellar, Dave McNally, Pat Dobson, 420 game winners. Their manager, Earl Weaver, he was a big influencer in my life, believe it or not, a baseball manager. First of all, I just idolized the Orioles back then, especially. And I just loved the way he managed his fieriness, but he actually studied and did analytics way before his time. He used to have lefties and righties platooning certain positions in the field because he wanted lefties against right-handed pitchers or righties against left-handed pitchers. He was always looking at the matchups. And even in his bullpen and pinch hitting at the end of the game, he always went back into statistics and used the statistics to give him the best chance of succeeding. And that's what it's all about. These numbers don't guarantee us what's going to happen next Monday through Friday, but they give us a lot of history on what the market has tended to do. And I think that information can help us. But this is the S&P. Let me show you the NASDAQ. So here's the NASDAQ going back for the last 50 years. Here are look at 27%, 21, 21, 3 really good days, plus 5% and minus 21%. Which days are which? Come tomorrow night. Just a little bit of a teaser. I got some great information I'll be sharing with you tomorrow night. It starts at 4:30. It is a member-only event, but you can come in as a free trial. So start your free trial. If you like our service, you can then come in and use our spring special to get the best deal. So it's a great time to check us out. All right, let's move on to earnings. And I'll combine this with the 3 you must see, and we'll try to get out of here by 9:30. So here's Dick's Sporting Goods. As I mentioned, came out last night with earnings. 285 versus 243. 285 versus 243. And what happens? The stock goes down. Let's see what it's down now. $10.5% pre-market. And by the way, if you don't know this, you can go in here and just click on symbol summary and then type in any symbol, pre-market or aftermarket. No, you can get your quotes, pre-market and after hours. That's how you do it over at Stock Charts. Anyway, so there's your Dick's Sporting Goods morning. It was down, by the way, close to 20%, I think, at the low. So it has come back some. But inflation, supply chain issues, those were things that were mentioned, and they cut their financial forecast for the full year. And this is why we follow technicals. We don't wait for the news. Look at what's been going on with Dick's Sporting Goods. Let me go in here. Let's go back to the regular chart. Whoops, it's not the one I wanted. Relative chart. Okay. So here, first of all, AD line. AD line's been dropping for close to a year. That's been, at least one secondary signal of distribution. But just look at the chart. I mean, we put in the double top. That would have been early September, late November. And from there, and by the way, going up, looks like maybe a little cup. So maybe we're just going to put a handle into 20-day. Nope. Went down, lost the handle, lost the moving averages, lost this support, lost gap support. And on a relative basis, well, you can, first of all, you can see that the specialty retailers started going down back in November. So Dick's, when it actually held up right here, was showing relative strength. And even through all of this, when you look at what the actual group kept doing, it was hanging in pretty good. And just a few weeks ago, we had Dick's at a 52-week relative high. And this is what has happened to one of the leaders in the space. It was over $100 earlier in May. It's May 25th now. So that would have been what, the second, third, fourth? May 4th, it was probably $103. Yesterday closed at 71. And now with, where was it? Here we go. Now we're down 63. We're down 40% in 3 weeks, under 3 weeks, 40%. That's how brutal things are starting to get with many of these retailers. So again, let's go back here. Oops. And we pull up that relative chart. And I just wanted to show you, look at the relative strength of specialty retailers versus the S&P 500. It's one of the most difficult areas to be in and has been like that since November. This is why when I go through, I mean, I used to have a lot of specialty retailers in our portfolios. Haven't had any for a while, and this is why. You've got a lagging group. So even if you've got a rock star like Dick's on a relative basis, setting a 52-week relative high, when you're in a bad group, sometimes it eventually just wears you down. And that's, finally, we saw Dick's, just succumb to all the pressure. It's been a rough month for a lot of stocks, but especially these specialty retail, many areas of retail, not just specialty retail. I mean, you can go into the apparel retailers, home improvement retailers, I mean, everything. Footwear, all these different areas related have been getting hit very hard. Anyhow, let's take a look at maybe three more. Oh, it is 9:30. That went really fast. Let me really quickly do three stocks that reported earnings. We're going to start off with Agilent. Good news is we'll have the open, so we can take a look at what's going on with the open. So Agilent gapped up, but it's pulled back. AD line pretty good. Agilent reported $1.13 in earnings versus $1.11. They got a gap up, still haven't broken this downtrend. It is in the medical equipment group, and this is a group that tends to really like this time of year, May, June, July. So I'm actually expecting maybe we'll see some relative strength and maybe even some absolute strength in this group. We'll see. Agilent starting to show strength against medical equipment. Medical equipment coming off its 52-week relative low versus the S&P. I'd really like to see this breakout right here. But anyway, Agilent improving, had good numbers, gapped up, but still not immune to the selling. Let's wait and see if we can get a breakout above the 50 there. Toll Brothers. I mean, home construction. I'm afraid to see these reports, but home construction's gone down so much. A lot of it might be built in. Toll Brothers actually beat $1.85 versus $1.46. Your reward, 18 cents. Up 0.4% right now. After just brutal move to the downside, they beat on their estimates and the market just yawns. That's the market we're in right now. Last one I'll give you is Nordstrom's. JWN reported yesterday after the bell. We are seeing a little bit of movement to the upside, almost 2%. But this is one of those apparel retailers. Here's the apparel retail group that I was talking about, going down, setting new 52-week lows. Nordstrom's relative, it's been some ups and some downs through here. For the most part, we're right about on a relative basis where we were at the beginning of the year. But we've seen some ups and downs, little roller coaster ride. The big problem, though, is that retail apparel topped back in August of 2021, and it's just been trending lower relative to the S&P 500. So it's just a poor group. And Nordstrom's came out, they were expected to lose 8 cents this quarter. They lost 6. So it wasn't a horrible quarter. It was actually better than expected. And yet, this one, we got a huge move, right? Up almost 2%. Anyway, that's what we're looking at this morning. Let's get a quick update of the market and we'll wrap this up. Dow Jones down 72, S&P down 3, NASDAQ down 1. Not bad considering where the futures were. So at least things are a little bit better. Volatility index still hanging up there around 30. That always scares me. I mean, at some point we could hit that impulsive selling, that capitulatory move. It could happen at any moment with the VIX up at 30. And that's the scary part. We might see a 10% rebound in the index. I don't think it'll be that much, maybe 6%. We could see that, or we could just see the floor fall out on the market. And I don't know which one is more likely at this point. I'm not seeing signs, other than we're just oversold. I'm not really seeing signs that we have this imminent rally coming based on, everything we're looking at in terms of sustainability ratios and so forth. Money is rotating in defensive fashion, which tells me Wall Street remains nervous, not buying into this market even at this point. And if they're not buying into it, why should we? It's kind of my approach. Anyhow, that's it for today. Appreciate everybody tuning in. Tomorrow, you can catch the next Trading Places live show over at Stock Charts TV, 9 a.m. So make sure you can tune in there. The next Trading Places live right here at EarningsBeats will be next Monday morning. So make sure you're tuned in there. That is the 30th, or no, it won't be Monday morning because that's Memorial Day. Sorry. Next one here will be next Wednesday, which will be June 1st. So we got a couple of stock chart shows first. And then also tomorrow night, this webinar, if you haven't seen these historical trends, I promise you, your jaw is going to drop on some of these statistics. So make sure you check it out. If you're not a member, go over to EarningsBeats, check us out. You can sign up for a 30-day trial and then check out our spring special as well, along with the webinar tomorrow night. Anyhow, everybody have a great day. I'll see you over at Stock Charts tomorrow. Happy trading.